Your calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
Hey, good afternoon, Market Rebels and all of our YouTubers out there. There's that sound, Stu. It's the closing bell, and that means it is time for our favorite day of the week, Coach's Corner. Coach's Corner. So we do this to highlight our professional coaches and traders here at Market Rebellion to help you, the viewers, make better decisions. And today, Stu, we're going to do it in spades because we have a super special guest, and I do mean super special, that is going to just have unbelievable stories. We are joined by Mr. Stephen Levick, and his resume is really too impressive to even go down the list. But let me just give our viewers a little bit of the highlights. He was a partner at Spear Leads and Kellogg, was a specialist, and this is back in the day when Dell Computer was probably the largest book in stock market history. So you can only imagine Some of the war
And
stories
if
we're
not,
going to,
very close.
you know that well.
Absolutely. Yeah.
He was also a managing director at Goldman Sachs, name we've heard before, Stu. And if that's
Goldman
not,
Sachs, the evil empire. There you go.
we know that one. And if that's not impressive enough, he is also currently a general partner, and yes, that means part owner of our very own Tampa Bay Rays, of which I'm a huge fan.
Go.
So, Steve, thanks so much for sharing your expertise and helping us out today.
Yeah, I just want to correct.
Congratulations on the career and the Tampa Bays.
Thanks. Well, I just want to correct that. To me, the evil empire of the Boston Red Sox. So.
Oh, of course. we knew that. So because we have such a special guest here, we're going to skip Chalk Talk today, Stu, which is kind of a little trivia question that we answer at the end for people. But we want to get right into it today. And Steve, what I thought would be kind of a cool little icebreaker, and I'm sure one of the questions that our viewers would have, you are a specialist on the Philadelphia Stock Exchange. Could you please explain to our viewers what is a specialist and how is that different from a market maker?
Sure. Specialist is the person that you as a public person, your order would be entered through your retail broker, for lack of a better one, say E-Trade. And then E-Trade would be sending it to the place where it trades, and that would be sent then to me as the specialist. And I would put it on what we would call a book. It's electronic now. And I would represent your order for E-Trade. At the same time, I'm also filling in the balance. If you were the only bid at that price, I am filling in to make up some of the volume. So we have a fair and orderly market. The market makers are those that are trading the same product at the same time in the crowd. They have no real responsibility other than the rule set to maintaining the public order. They know that, they don't go first. The public always goes first, but they help fill in the balance also and provide liquidity. Now, a market maker can make a better market. He can improve on the bid if you send an order in for $2 and a market maker, and that becomes the bid, the market maker can say, I'd be 2.25 bid, and that then it becomes their bid. I am still representing your bid. I can join a bid in those days. I'm not sure what the rules are now, but essentially I'm the house.
Right.
Lack of a better term. I am handling the book, and I am the house. I know what the orders are. The market maker is trading for their own account and knowing what their positions are and only worrying about that.
I see. So if we were to look at
Steve, how many books were you actually running?
When I first got to Philly, we had about 20 books, and by the time that I left, it was 120. And that was still long form specialist, not electronic books.
Electronic, yeah.
So, but we had 120 books, let's say, and 70% of our volume was Dell Computer.
Oh yeah, back in the day, Dell was a trading beast. So just to kind of clarify it, so if we were to look at a schematic, the specialist would be on top, and you would have market makers underneath you to also filling orders in the book?
It was a specialist system. So the specialist is ultimately in charge. You could get into a philosophical debate on who was really in charge, depending on what the crowd was and what they were willing to do. In a very forthright manner, I was never a big believer in, if we're the specialist, we have to be the biggest boy on the block at all times. I was a big believer in we had to make sure the orders got filled. But many of the traders in the crowd at the time easily did much more volume than we did. But in times of stress, I would say that we did more volume than everyone combined. Because
it was basically your one of your biggest functions was to provide the liquidity that may have been absent from a floor trading crowd.
We couldn't walk away. And I don't mean it in a bad way to say market makers could walk away. Market makers had other considerations that, which was their capital. And in stressful times, your capital could tell you just can't do any more. And you did have to walk away until it settled out. And a specialist did not have, we had the obligation to remain and make fair and orderly markets.
I see.
Otherwise, you could have books taken away from you, and that did happen. Not to us, but to other people.
To others.
To other people. We won't mention those names.
Right, exactly.
Well, another question that I think everybody, the burning question, if our viewers could ask one of a market maker, because we hear this all the time about how market makers take prices up, they push prices down, they saw my order coming, they're not filling it, they're ripping me off, all of that stuff. So this is kind of a multi-part question for you. But
and at this point, we're kind of putting market maker specialists.
Yeah, I was going to say,
market maker specialist, kind
exactly,
of all in the same camp. But
yeah.
Can the market maker / specialist manipulate prices? And if so, to what degree? And then part B, what about for today's markets that are so largely electronic?
Right. Well, for part A, they could try. And they actually could be successful for a very brief period of time, but ultimately it would end horribly. Because if you're trying to push things up, unless you're going to do it across the board, you would need incredible amounts of capital and reach. And there were so many strikes and this and that. So whatever you forgot would create a value proposition for somebody else to come in and take advantage of. And then you have to keep the roost up. It implodes on itself. There isn't enough capital. And ultimately, there is a reason that things trade at the moment at a certain level, and they are not manipulated. They are made by a crowd sense rather than an individual sense. An individual can have an order that can push a volatility for a brief period of time without even meaning to. The order can be so large as to push volatility, but eventually volatility will fall to the volatility it is deemed to be traded at in a general sense. One order will not change that. It is made up of so many more variables.
Yeah.
Reversion to a mean.
Reversion to the mean.
Yes. Yeah.
Now, what about for today's markets?
Today's markets is even more difficult. In the older markets, the spreads were wider. So there's your opportunity, right? Mm. You could definitely, you could make things last longer. In today's market, it is more than likely, for argument's sake, that you could come in with an order, and let's just say this was an open outcry order, not an electronic order. And, you come in and a market is 1,000 up and say, it's 240 offered at 242, right? And I'm talking about $2.40 offered at $2.42. And you come in and you say, I got 30,000 to buy at 240. And then you think, in the old days, people might scramble and try and take other things so they could be ready to sell to this order or that. Yep. And then somebody turns around today and goes, I'll sell you 30,000 at 240. Now offer it at 240. Now offer it at 238. What do you want to do? And then your game is over.
It's over.
If you were trying to scare up the markets, you could do it. You couldn't do it. And my first job was a specialist clerk in 1980. And by 81, I had grown up enough that they let me in the option crowd as a specialist clerk. And I worked for a guy who, in those days, you actually could get away with it just long enough for your own purposes if you chose the right moment. And this guy was a master. He eventually got carried out for his troubles. And he would go in and he would do it through the stock. And we were trading Coastal Corp at the time. It was a takeover rumor. The markets were very illiquid, and that stock was completely illiquid. And he would go in and he'd give an order, and I'd listen to it on the phone. He'd say, buy 200,000 at the market, don't buy a share. And simply put, what he wanted to do was have the guy run out in the crowd in the New York, tell him I got to buy 200,000, and they would the specialist would walk the stock up, not want to sell him anything. And then all of a sudden, the market makers, for lack of trails of information, and the public would come in with orders very quickly based on these rising prices that really weren't trading. So you could trade 100 times the volume in the option markets at the same time that actually the stock is being indicated up, but isn't really trading much. Yeah. And then he just simply canceled the order. The stock would fall back to really where it should have been. And then the following orders would come in the other way. Yeah. Now, that is attempted market manipulation. And it was great, Until the one day where he walked in and he said, buy 200,000 at the market and don't buy anything. And he got filled up an eighth.
Mm.
And that cost us about $1 million. And in those days, $1 million was
real money.
Was real money.
Yep.
It was $1 million. Yeah.
And it was actually worth $1 million.
It was actually $1 million.
And that ended that escapade. But it went on. He did this for a while. And, in those days, this was 1980, and the markets were really just getting caught up in the whole idea of the new, the idea of the option guys and the stock guys. They were like on different planets. And there wasn't much communication. And I'm not talking about communication of I have an order, much communication of knowing what one floor had as an order versus another floor.
I see.
So, in today's market, there's complete information.
Yeah. Well, we've talked about that before, Stu, with because so many of the traders out there all think that market makers, specialists have this incentive, if the option's trading at 5, that they want to take it up to 6 or 7 or 8. And they completely misunderstand that they're trying to balance the market. They have no incentive to balance the market. And so they're really kind of responding to what the market's doing as opposed to being the puppeteer, which is what everybody thinks is happening. So just to clarify, so you're saying this whole urban legend myth about the market maker specialist just artificially pump prices up and take them down and at a whim is, at least in any type of a sustained sense, is just not possible.
Yeah, it's actually counterproductive. I don't even think it's attempted anymore. It's a false flag.
It's a falsehood. It's just nonsense.
Right.
Yeah.
Right.
Yeah.
Well, Stu, you've talked about that with the where the retail traders in a lot of ways have an advantage over the market makers. And I think that's an interesting perspective because, again, everybody thinks it's the market makers, that it's us against the market makers. Why do you say, and if maybe you could talk to Steve, or at least a perspective, why do retail traders have an advantage?
Today it's a market taking situation. The markets are tight. They're liquid. They are at times pennies, 1, 2, even pennies apart.
Right.
The retail trader today has the advantage to do what they want, when they want, in pretty much any name that they want, at a level that is commensurate to their risk adoptive policy, and that's a huge advantage to be able to have the ability to say, I like this, I don't like this, I want to do this, and pretty much do it at a current price, walk away from it, get in, get out. That was one of the big issues that Steve and I used to have. You got into a trade. Sorry, you got into a trade, but how do you get out of the trade? That was a big problem as well. Today, the markets are so tight that you're in and out, and it's fine. There's no issues.
Yeah.
And that's a huge advantage. And especially when you have the tools that are advantage today on most of the platforms, the analysis tools, the ability to say, well, if I put the strategy on, what's it going to look like when the stock moves 7 points or 17 points 2 weeks down the road at an implied vol that's 4 or 5 ticks up or down? You have the ability to actually come up with an answer with the tools that are available. We didn't really have any of that. And for those people that don't take advantage of these situations, it's just nonsense that you wouldn't. I don't know why you'd be in the game.
In 1980, what they had was that they call Monte Weber machines. And
Monte Weber,
that was the only valuation.
Matrix printers.
Yeah, there were no computers and there were no anythings, right? So you had these things, and the clerks were sent out. And like if you had a stock that moved, you'd have to go to the machine and you had to plug all this stuff in, and it would print it out like a grocery receipt. And you'd run out to the specialist, and already the stock had moved too much. Now they're sending you back. Well, when things were really busy around the floor, the line at the Monte Weber machines was like, the
couldn't
line
get in
at a box office. It was just,
yeah,
it was crazy. And this is what we had. This is it. This was all we had. As far
today,
as
everything's at your fingertips.
At your fingertips.
Right. So,
Steve, could you explain a little bit about that? Because back then, you were just reminding me, without the computers, didn't you have to, especially as a specialist, try to understand the risk by eyeballing it, or maybe looking at conversions, reversals, box spreads, and trying to say, how many deltas do I have? How would you do that back then? How would you figure out how much
you know,
risk you had?
on the level of valuation risk, because, you know, that was starting to be a new game. The bridge players and the backgammon players had just started to hit the floor, and they had knowledge. And so on a valuation basis, they would put your markets in line if you were too far out of line. But you tried to get your calendar spreads to trade correctly. You had a sense of where they should be. And then you wanted to make sure your reversals and conversions, and I'm not going to go into what those even mean, but they, you know, it was a known quantity, and that you could do on your own because it was simple calculation. As actually my first professional trading job off floor was doing reversals and conversions. But you could figure out your strike valuations, you could figure out your calendars, but you couldn't necessarily figure out, and you had a sense of where your verticals might be, but the nuances were all wrong, right? If any assumption was wrong, then everything was wrong. And somebody would come in those days and put it back in line. And when I say they'd put it back in line, they'd cost you money.
Oh, sure. Yep.
You know, because you'd make a bet somewhere. And that was part of the problem. You know, sometimes you wanted to do something with your position. And there weren't a lot of opportunities. Most of these are 5, 10 lots coming in, but a 60 or 100 lot, which was a big deal in those days, would come in, and you do it. And then you'd find out later that wasn't the one to do, right? And it looked all right. It measured up against how you had things, but now you were already giving away about a quarter or a half a point. And that was the difference in being right on the first level, because you expect as a professional to make that quarter or a half before the trade itself starts unfolding to be where you see it going. And instead, exactly. you were in the hole already.
Yeah. So market makers are at risk. I think that's something a lot of people don't realize. It's a very risky business. And also for the fact that many of the times you're on the wrong end of the trade. If everybody's seeing Dell Computer running to the moon and buying calls, you're having to sell calls. You're on the short call side. And they never seem to put that into perspective.
No, yeah. I mean, when they say that, when the public complains, and they complain now, but when they complained in the 90s and the 2000s, it was that we'd be running the volatility up. That was what you're running the volatility up. Well, we're not running the volatility up because we're going to take advantage of you. We've sold the volatility the whole way up, and pretty much if we're running it up, it means we sold a lot down below, and now appetite for what we can bear isn't as great as it was initially.
Exactly.
So
right, the trade is actually going. In other words, it's going against us.
It's going against us, right?
Right. In a perfect world, if you guys all wanted to cooperate, you should give us an order to buy something, and then somebody should be giving us an order to sell something, and then all the markets will be fair and orderly at the exact price you want it to be. And it doesn't.
I love it.
It only works. Generally, orders go one way. They're either all for sale or they're all to buy. They rarely are going back and forth.
To cross them, yeah.
Yeah.
Yeah, very true. I love it. Let's do a quick little blurb here, Stu, for anybody who is interested in options trading. Check out marketrebellion.com/get started. Lots of free courses and things to help you get started. Now, for Stephen, I've got another question here that we often hear about. John and Pete have this little catchphrase about discipline dictates action, what they sometimes call
move the slide over. There you go.
DDA. And so the question is, which also includes having a plan. And so the question is, could you share a trade where maybe a lack of a plan, either from you or somebody you knew on the floor or something, turned a great trade maybe into a really horrible one?
Sure. What comes to mind is sometimes you can't plan for the markets and the time and the execution time, and everything is made up. It's not just simply a matter of stocks trading at 20, I do this, it's trading at 21, I do that. Well, there's also, you got to get to your order when the market's open, that you have to go through a rotation. This is in those days where they'd have to open each individual option, and that all takes time. And quite often you had to take all that into account, and if you didn't, you were subject to the whims of the marketplace. And the most extreme example I know of that was the day after the 87 crash. Most people remember the crash. They don't probably remember the day after. Traders do. Certainly traders do. And
absolutely.
The market opened in the hole. It looked like, if you could believe it, at the time, it looked at that moment like it was going to be worse than the day before. And if you weren't done then, you were at that point, you threw your hands up, and people were frozen.
You were about to be done. It was a scary time.
Yeah, it wasn't a technological freezing. It was an emotional freezing of people, professionals not knowing what to do. And an order came in, and a bunch of orders came in into the XMI future. And the XMI was loosely based on the Dow, because you couldn't trade the Dow, but they changed like two of the stocks, but it was as close as you came. And the XMI, would theoretically could move the Dow. It never had been, it was a good product, but not a great product, but it was a good product. It's not like the spiders are today, but it was good. An order came in the depths of this to buy them at the market and started taking them up. The difference was, as opposed to a market manipulation, the markets were more emotionally afraid as opposed to order afraid. So it wasn't so much that there were so many overhanging orders that this thing could get swallowed up right away. It was the emotional tide when the initial orders were to sell that everyone just gave up because they had nothing left. And so when the order came to buy, there were no offers.
Wow.
There were, those were taken out very quickly. And then they came in with the second and third wave, and it all came in within 5 minutes. They were in the middle of their rotation, and they hadn't.
And these are the futures. We're talking about the futures, right, Steve?
Right.
Yeah.
So, these were the future. Well, the XMI futures, but the XMI options on the Amex, which were big. This is what I'm talking about. They were in their rotation.
They were in the middle of it.
Right. So they, you were, as you would get to a strike, the future is moving, and you're basing your strike opening on where the future is at that moment. Well, a friend, someone I knew very well, had thousands of XMI puts that he had made a fortune on, and he put them out at 8:30 in the morning before the market opened at the market. Like, he knew, the crowd will probably, give themselves a little bit of edge at the moment. But that the market was in the hole, and he was going to do well on top of how he had done the day before, because he had owned these
on the actual day of the crash.
Yeah.
I was going to ask, when did he buy these? He bought them the day before the crash?
No, he had bought them. He had bought them the previous week. This guy
he had them into the crash, and he made a boatload of money.
Into the crash. Gotcha.
Phenomenal trade, Hall of Fame trade.
Right. And now the futures are moving up, and you guys all see it as the implied. When we look in the morning, hey, the futures are up, and that means the Dow is going to have an implied opening of up 350 points.
Yeah, I think the market was down. The market was down 900 or 800. That is six. I forget what the number was on the day of the crash. What the exact number was, but it was 6, 7, 800. But don't forget, you're talking about a Dow that was down 30 to 40%.
Right.
The next morning, the initial pricing, I think, was down another 400 points. Well, by the time these orders started coming in and got some footing, because there were always buyers on the sidelines, they were just emotionally bankrupt. Nobody wants to buy, the thing had already fallen off a cliff. They had orders, but they were too scared to put them out there. And all day on Monday, you were getting filled below your bid. And specialists were happy to give it to you below your bid, because the markets were moving so fast that the quotrons couldn't keep up with the quotes. There was a technological lag. The market went from down 400 to up 400, which sounds like an opening today in about 20 minutes. In those days, you're talking about another 30 or 40% swing in the time that it took to get through to near the end of rotation to when you got to this guy's particular puts. So he took a 30% hit on his potential profit of what he would have ultimately made. I remember speaking to him that day, and it's still a tough subject. What are we 36, 35 years later, and it's still an
open wound.
Yeah.
And here's an example of a trader that had a plan. the plan didn't work out. He had a plan. It didn't really work out. His alternatives were to cover pieces of it on the way down, to roll them, to make adjustments to the position on the way. He chose not to. He took a great trade and turned it into a horrible trade.
Right.
And it happens.
Right. And that's about discipline. Like, I mean, because we had talked the night before, and I said, did you want to sell? They're going to tank in the morning. That was all he said to me. They're going to tank in the morning. And he knew he could have sold them on the close, walked away with a bundle, but they were going to, and he was right. They did tank in the morning, but not by the time they got to him 10 minutes later. And that's how quickly it can happen. It can happen like that. If you have an idea in mind and you think you're at that price where you want to be, and you think that, you're fighting, there's two urges. One is to do the right thing, which is the right thing, but it doesn't leave you with a great feeling. And the other is, I'm going to get the best price anyone's ever gotten. And that's the thing that'll kill you.
Very well said.
It'll leave you, you'll be the offer out there, the news will hit, and it's like the orange juice report. It really just turns on you like that.
Yep.
And in plain English, don't pick the top. Don't try and pick the top.
Right.
Don't try and pick the bottom. It's never going to happen. So make adjustments along the way.
Right. And be okay with it, because
Be okay with it.
Right.
Yeah.
Because as a trader, you got to go again. I mean, I asked once with our baseball team, and I don't want to get into too much of that. And I said, explain to me. And they said, players are aware of their statistics. So for motivation, they always know, each hit does matter, and they concentrate on each at bat. It doesn't matter what's going on in the game. It's like you think they all give up. They never give up, because it's an individual statistic and it's a team sport. And in trading, look, you're never going to get the top. You'll get it once in your career, and it'll be a story you tell. All right. And then if you keep fighting it, you might as well go buy lottery tickets, because you'll probably have a better story to tell. Otherwise it's just going to be disappointment. But you can be a professional and, take it off the table, put it back on tape, take it off, put it back. And that's how you do it.
Yeah. I think another moral of that story is just that how the whims of the market are really what dictates the outcome, not what you think, which are things that Stu and I talk about. It's not what you think that matters. And that's why you got to have a plan, understand some of the hedging, rolling, risk management techniques to survive.
Right. Exactly.
Yep.
What's that quote by Elroy? More things can happen than will happen. Right, Bill?
Beautiful. Well said about
absolutely
about uncertainty and randomness. All right, maybe
What's next?
How about if we spin this in a different direction? Same question, but or maybe where a plan turned into a great trade, or maybe a good trade into a better trade, where a plan actually helped a trader.
Okay. What comes to mind? Now I'm drawing a blank. I can tell
there's a story running around the Philex. I wasn't there. That big Dell trade. I mean,
sure. Okay. Yeah, I know. Yes. So the greatest trade I saw that I wasn't at work that day was in Dell Computer, and I was happily in an arbitration meeting in Baltimore at the time.
Oh wow!
Did you win the arbitration?
We did win the arbitration. No, we won because we got removed from the arbitration, being a party to the arbitration. It was left to the executing broker, who, I'll just say the word fuzzy, and Stu, you could fill in the rest.
Small victories. That's what counts.
We were dragged into something we had no business being a part of, as we were told by the person there. Anyway, so long story short, it was in the middle of the Thai currency crisis. Volatility was at a historic high individually in
late 90s, long-term capital.
Yeah, it was like, was it 96? No, 98, 98, something like that. Yeah. And we were up in New York because the systems were getting rebuilt in Philadelphia. They couldn't handle the volume that we were doing at the time. And then they turned their system into the greatest one in the business. Mm-hmm. But Merrill came in, and it was like bang, bang. You just walk in the crowd like, I got 10 to buy. Well, no, they didn't have that. They came in as market order. The stock was like in the, I don't know where it was, but let's, for argument's sake, say it was in the 130s. And the guy had 6,125 puts to buy, 4,130 puts, and 2,800 135 puts to buy at the market.
Whoa.
Down. right now, like
Bang.
now, like, don't come back to me.
Big trade. Big
That's
trade.
my order. And
Big trade.
you're talking about, yes. And you're talking about the second month. It wasn't the front month. It was the middle month, which is where all the Vega lays in the second month, right? It's just the point of
talking in excess of 500,000 deltas,
right.
A lot of shares.
And you're talking about at the time volatility being around 70, which
high.
Was in a stock that usually ranged somewhere between 25 and 35, and right before earnings at 45.
Mm-hmm.
And it was at 70 because of the Thai crisis, and it was hitting the technology stocks, and Dell was the leading technology stock.
Absolutely.
And the offer on one of the series was $6 on the screen. And all he wanted was a price. I need a price right now. And they gave him a price somewhere around 11. And that was fine because, that was, or no, it wasn't that one. I'm sorry. That was the 2,800 that went from 6 to 11, because what you're allowing for is that's a straight delta play with premium. And it's like, fine. And then there was another one, whatever the price is, it was like up $2, up $3, right? And they got it filled right away. Now, you're in the crowd, you're the specialist, and the specialist was Stu Sternberg. He had come in from the main room because Al was in Baltimore. Alphonse Pissarro was our lead specialist, was in Baltimore to make this market. They had yelled over to him, you got to get over here. And he came in and he the broker looked at him. It was this guy, Eddie from Merrill. And he says, 6,000, 4,000, 2,800. And he said, and that was it. And the crowd, as he said to me, he said the crowd was speechless. Like nobody, they didn't know what to do. They all had no more capital. It was that moment. I was on a regular basis talking to individual traders who said, look, I can only close today. I can't open. And I get it. You got to feed your family. And it was that kind of moment. And a couple of them were like, I'll do this one, not that. And it was like, no, you're doing them all. You're a market maker. You're doing every one of these trades, right? And they were all good trades, but you can't cherry pick this thing. And they got it done. They lifted the book on any offers that were around and traded them at a block price. And then everyone went in to hedge the position. Now, what turned this into a great trade was Stu, in his mind, knew the only way this works, because everyone's going to run out to sell stock. Right. Because basically you're going long 500,000 shares. And it's going down. So you're going to put stock on top of stock. And you've just goosed the volatility up. So you're going to hopefully invite in vol sellers if they still exist. Well, he got lucky on one side and he was smart on the other. What he decided was, at the moment, he turned to a couple of our specialists and said, don't sell anything, right? Don't sell a thing, stock-wise. And they were crazed. And he says, no. So we were long. We had done over 60% of the trade. So we were long over 300,000 deltas on this trade, and we did nothing. And the
$100 stock that was tanking.
It went down $7 in about 2 minutes, and then 10 minutes later, it was up 12 from the bottom. So it was up 5 from the trade.
That's in excess of $2 million, everyone.
Plus, we had run volatility up to be able to be liquid for the trade, up about 6 to 10 clicks. And it set off the alarms that of all those that were left. And since that stock had solidified, and so had the market at that point, this was all in 10 minutes. Like, the guy came in to close out his position at the exact moment that a rally started. So not only did we get the stock to rally, we also got volatility to come in. So where he walked in with volatility at 70, sent it up to 75 to 80, it was now back down. And this is all in the course of about an hour and a half in the mid 50s, where it resided for the next couple of days. So it was the home run of all home runs that I've ever heard of.
That's an unbelievable story.
Right. And that was, he had a plan that if he was doing this trade, he was going to take the gamble that and he didn't know there'd be a rally. What he knew was after the market makers had sold the stock, or the pros upstairs had sold the stock, that it would rally back a little bit, at least, from where they would send it down. Now, he had no idea it would go anywhere near what it did. Mm-hmm. And he would hope that the volatility would come in, since he had lit it up so high. And that did happen too.
A little bit, Stu, like we talked about.
And a moral of the story, one moral of the story is that the Dell puts in this story, and correct me if I'm wrong here, Steve, that they were priced. First of all, the guy could have said, no, I don't want to do them at that price. But they were priced to accommodate the risk that the other side, or your specialist and the traders on the floor, had to take in order to get the trade done.
Right.
It was price was the great equalizer here.
Yeah, I've had situations where we had illiquid stocks that trade 500 contracts a day, and a guy comes in and he goes, I want to buy 5,000 contracts. They're unhedgeable. And you could at times send them back and say, listen, I can't, you're going to have to find some help on this trade. I can't price this in an orderly way. I'm going to need some help. And that would happen. I mean, usually those kind of orders came in illiquid stocks that didn't trade a lot of volume on insider trading. Yep. And you never get that money back. You just don't. They're unhedgeable. Yeah. And this was one of the most liquid stocks, but at a very illiquid moment. And they knew that the broker knew, and the customer knew. The customer was thrilled. We heard back. They were fine with the pricing, and they knew to get it filled at the moment, which is what they were most concerned with at the moment, and they got it. So it was like everyone
got what they wanted. The traders accommodated their risk by making price what they felt was okay. And look, it could have gone the other way too, right, Steve?
Absolutely. I mean, absolutely. There are countless stories of it going the other way.
Exactly.
I mean, those are
it's going down, and all of a sudden you're out of business.
Right. Exactly.
Well, Stu, I think we've got to get maybe a couple of more minutes here, but
we got a few minutes. Yeah, we got a little bit of time.
Let's see if we can sneak this one in here. Another question that we always talk about is relative pricing. You don't. It's not about what you think that really matters. You want to do a trade because there's some kind of an edge. Could you give us one of your stories where you have made, whether you personally or as a specialist, based on relative pricing?
Sure. 2008, in the fall of the crash, whatever you want to call it, in 2000, of the end of the world, I call it. The big term being thrown around were credit default swaps. You were hearing all about them, and they were insurance against bankruptcy, right? And they were and they had implied volatilities to them, and us common people didn't really know, couldn't trade them, didn't have access to them, but we would hear on TV, the implied volatility has moved up from here to here, and it was a number, right? But I was like everyone else, losing a lot of money in our family account, but I was still, and I was 6 years out of the business, but I was still watching. And in those times, I was watching closely, and I noticed in Goldman Sachs, because I always watch Goldman. I don't think I owned any shares anymore at that point, but I looked at what were called the baby puts. They're the way out of the money puts.
Way
Stock
out,
140
way out of the money.
Right, and they had strike prices starting at 10. Okay, and they were 10.
With the stock, and how much was the stock, Steve?
I think it was 140 or 120, something like that. It was
these are out of the money puts, way down there. 2 deltas, 3 deltas, 5 deltas.
And usually the skew is you go down in those kind of, for insurance, you pay a little bit more. And if the skew at the money is somewhere around 30 vol, for argument's sake, the skew on the out of the monies might go as high as, well, it could go high as anything. But at that time, the skew at the monies were about 25. And, Goldman was actually trading somewhat liquid, but the skews in the out of the money were 40, which a little bit high, but not really. But the credit default swap was somewhere around 65% that day, is what they had said. And I had heard that. And I'm saying, this has got to be wrong. Like the volatility is offered at 40, and it doesn't make sense. So I went in, in my account, and I had to call a broker. And I said, listen, go in and try and buy 500 each of the 10, 15s, and 20s. And I walked out with like 400 puts, and they moved the markets. And I was like buying a put, for argument's sake, I bought a put at 20 cents. I bought the 15s at 30 cents. I bought the 20s at 50 cents. Well, immediately, like the 20s became 70-cent bid. So I wasn't going to be buying anymore. It was like I had caught them and I got what was there, right?
But the reason that you bought them was because you, on a relative basis, you felt that they were cheap.
Yeah, they were
the price of the swap.
Right. If the swap was 65, the put should have been 85.
More of what? Sure, far more.
Right. So if the swap was there, so what they immediately did was they turned the markets to the new offer of volatility became this credit default swap offer, which if I was really aggressive, I would have known was too low also, and I would have kept trying to do it, and I probably would have gotten a hell of a lot more. But I didn't, because I thought I was the smartest man in America, and I was busy patting myself on the back. And sure enough, I was out by like the next morning. And Goldman then proceeded to fall to $40, and volatility went over 100. And to give you an idea, when the stock was 60, and remember this, when the stock was 60, the 10 put was offered at $3.
Oh,
unbelievable!
That's volatility.
Unbelievable!
Wow!
I can't even put a number on that. That's like GameStop.
That's volatility.
Unbelievable.
That is a sweet trade. Well, Stu, unfortunately, I think we have another webinar that they're signaling us here. We've got to start. But as much as we'd love to sit here and share war stories, it's been an incredible. What's that, John?
John?
Oh, we can. Okay. Oh, okay. We got the green light. So very cool.
Okay.
Excellent.
So let's go ahead and move on to another question. We did a brief phone call with you before we did this. And you had mentioned very casually that you have only known 3 great traders. So my question to you is, who were they? If you're allowed to mention them, if not, it's no big deal. But really what I want to know is, what made them great? What, from your mind,
what are the attributes?
What makes a great trader?
Right. Let's see. The 3 greatest traders I ever met were, the first one is Randy Dorfman. He's not necessarily number one, but he is a phenomenally great trader. And what makes Randy great? Randy has the conviction of opinion backed by skill. And look, if all it took to make a great trader was conviction of opinion, I only had great traders working for me in the worst of times. All right. So Randy is the proverbial bull in the china shop. He is loud, he's verbose, he's rude, and he is right. He is aggressive. If you think that 500 contracts is a huge order, Randy will do 5,000, and he'll say it to you like that, and he'll mean it. And if you don't like it, he'll do another 5,000. But you know why he's willing to do it? Because he's often right.
Because his conviction.
And that is what makes him a great trader. The second person is no longer with us, and was a good friend of Stu's and a good friend of mine, and partner of mine.
Close.
One of the sweetest guys away from the floor that you could ever meet, and one of the toughest guys you would ever run into on the floor. Each trade was their child's dinner as far as he was concerned. I mean, as you know, if you gave up an eighth, then you were taking food off his table, and he would tell you that. He was just intense. But what made him great was he was a market maker in the Dell crowd. He was a market maker with Stu, and he was always talented. What made him a great trader was being able to take what was in there for him and be able to spread it out over a complete product. And Dell became a complete product. And Al, rather than having to focus in as a market maker on a few particular things, was now able to act as if he was, a professional coach, and really just mold markets to where he thought things would go. And he had an incredible feel for volatility and the waves of volatility, and that the skews that normalized skews would tell you to set up a certain way. He might edge a little off that to invite orders where he would want to see them, to smooth out the wave that he would see. And a lot of it was by feel and valuation. And he was willing to shape that. So he would come into battle with the crowd sometimes. Now, what else?
What an art.
What else? Yes, that was the artistic part. What else made it great was he was one of the best traders to flip. He would know when to build up volume on a certain line because he knew that the orders would come to get it back, and he would put it out to him. And when it came to that, was just straight pricing. That was just straight flip trading, and he was excellent at it in the moment. It's actually one of the things that I was very good at. It wasn't a lot I was good at. I was very good at that. But what Al was really good at was allowing volatility to breathe. A lot of people get caught up in this thing that if volatility, it's a moving, breathing thing. And if it was 50, at 55, you make a stand. And Al always used to say to me, feed the fishies. Feed the fishies.
Let them breathe.
They come in, give them a little and then move it around. And he was like a maestro, and just, he was incredible at that. And it was the ability to have a complete product that allowed that greatness to come out of him. He would have always been a great market maker, but he's one of the few that, given the chance to be a specialist, was able to take his game up. Because for some people, being a specialist is a burden they can't deal with.
Yep.
And it's not like it's easier to be a specialist than a market maker, or harder, or anything like that. It's different. That's all. Not to cast aspersions on market makers. It's first of all, market makers,
different game.
Yeah, it's a completely different mindset. And not for nothing, as a specialist, you worked for a firm. Your firm could go out of business, and then you could go look for a job. As a market maker, more than likely, your food was now taken off your table. There's a whole different ball.
You're an independent. Yeah,
exactly. That is something I never could deal with in my own mind. So
yeah, that's always tough.
Now, the third grade trader, who was the best I ever met, happens to be the managing partner of the Tampa Bay Rays, is Stu Sternberg.
There you go.
And Stu is the trader of the Dell trade, and that was one of the greatest. That was the greatest trade I ever heard of, and probably the greatest trade a lot of the people that were in the crowd that day, or that. And as he passed along to me today, he said, "Just want you to know," he goes, "I was asked by Peter Kellogg the next day to have breakfast with him because he said, I heard there was a great trade in Dell. Can you come up and tell me about it?" So if you got called up to have breakfast with Peter in a Kellogg happy way, then you were in some big company. That's a something. The other thing I remember from Stu was back earlier in our careers when we were. He was the lead specialist in digital equipment, which was the Dell computer of the digital equipment era.
Day, sure.
Yeah, that was like 1983, 84. And Stu was a specialist. And one day, Digital stopped trading in the middle of the day. It was over 100. And floors those days were communities. People knew what people's positions were. And we knew that the Santangelo book and Stu were premium sellers. And we also knew they were long up the wazoo on deck on that day. And so when it stopped trading, they were long and short premium. And the indications were it was going to open somewhere between 70 and 90. And it opened at 90. And it was absolute bedlam. Anybody who was a trader on the floor was in deck that day. And there's Stu. He's not even at the post. He's in the middle of the crowd on a little stand. And he's just got his little badge on. He didn't even have his jacket on at that point. And it's crazy. It's trading the places. It's Eddie Murphy going like this and this, but for real. And they are the ones with the shitty position to start. But he traded so well in the moment that they took what was an out of business position into a profitable day. Not the most profitable day ever, but they traded their way to profitability when they, for all intents and purposes, should have been out of business. And I noticed that day because I came to the crowd. I didn't trade deck, and I didn't want anything to do with it. I'm looking at Stu, and I didn't know, we knew each other. Hey, how you doing? And I looked at him, and he's smiling. And I'm thinking to myself, this guy's amazing. I know his position sucks. He's getting it up the butt. And yet he's smiling. And I asked him later, And he said, yeah, he goes, look, I knew that I was trading well, but it was just the greatest feeling. There was so much going on and I was in it. I was focused. I was in it. And I had complete control of what I was trying to do and I was executing it. And
Beautiful.
that was it. And
that's what we need. We need
see why I
plans,
made
we
your
need
number one.
execution,
Right.
Yeah.
Yep.
Got to keep your, one of the morals I think of that story is that you got to keep your wits about you. You can't get emotionally involved. You can't get
And
emotionally
change your game
distraught.
plan.
You just have to keep your feet on the ground and keep it moving and know what you have and have a plan and execute and manage and just keep moving forward.
Exactly. Randy and Alphonse were the definition of emotion. They wore it on their chest. And Stu was the guy that in the moment could be cool as a cucumber, put a number on it, move on, and capitalize. That's
Beautiful.
a phenomenal ability.
Yeah,
Cool.
It is. It's
really cool.
One final question. I know we got to wind down things. As much as we'd love to sit here and pick your brain for hours, I could carry on this conversation. One of the things that we like to teach is, or conversations or anything, is to have some kind of a little pearl of wisdom or a little nugget that you could share out of all of the trading experience that you've got. If you had to share to our traders some philosophy or some motto to live by, what would it be?
Know your risk. Know your risk, and
You
don't
say that all the time, Stu.
Yeah, don't be
All the
greedy.
time.
If you think that you are going to get, it is human nature. I want to get the best price. Like I want to brag. It doesn't happen.
Right.
What happens is you make money, you move on, you continue to make money. And as a trader, if you hit over 500, you can make enough money and you limit your losses. If you are proud and you build on your losses because I'm going to be right, you are going to be out of business. And we owned a book because of that philosophy by a competing firm. And it is
interesting.
It is, you got to be around for the next day. So you need to know how to lose and you need to know how to take profits.
Love it. Well, Steve, I can't thank you enough. And I know I speak for all of our viewers. I just think I used to think Stu was the coolest person we had, but now I think you moved into first place for sharing your experiences with us.
That's after 2 games, I gather, right? Just wait till you play your 3rd game. And then but
it was absolutely a huge honor to have you here and sharing all of your war stories with us and your knowledge. It's not often that we get people in your level and Stu's level to share that. So we want to just thank you again, and hopefully 3rd time's a charm for our raise, right, in the series. And any final closing comments, Stu? Or well, I think
Mr. Levick said it all. Know your risk. That's the end of the game.
I think that's a good place.
Know your risk.
And I might add that those hats were not gifts of the Rays, but they are all available at the Rays store for purchase.
Which is where I got mine. I love them. So anyway, we want to sincerely thank you, and we want to thank all of our viewers for hanging in longer. We knew it was going to go long because there's just way too much information to pull from Mr. Levick, and we appreciate you sharing it, and we wish you all the best, and who knows, maybe one day we can borrow your brain again in the future. We'd love that, but if not, we want to wish you all the best.
Okay, great.
Thanks,
so much, Steve. Thanks, Steve. Thank you.